Wow, we were not expecting that.
No.
Now, when we make a video about investing, don't get me wrong, we expect some disagreement in the comments. But on this one, we expected it to be more along the lines of, you know, sure, it'd be great if I could have learned about investing in 19, but that's not realistic. And that's fine. That's why we made the video, because we wanted to put investing on younger people's radar.
What we were not expecting is all the hubbub about the 12% return. And it doesn't make sense because we specifically said...
But aside from the 12% return that Dave Ramsey assumes in that story...
Now we'll chalk that up to a misunderstanding, since many of you pointed out in the comments that 12% just isn't realistic.
Just because we can't expect the double-digit returns that we saw in the 80s and 90s doesn't mean that investing is dead. And if we want to cherry pick date ranges, I pick the last 5 years where we've averaged 18% between 2009 and 2014.
The point is, we don't want to just pick the best and worst decades. We want a realistic expectation of what the stock market's going to do over the long term. Of course, we can't predict the future, but we can look at the past.
And if you're one of those doomsdayers that says this time it's all different and we're all screwed, blah, 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 we made a video about that, and it's called The Economy is About to Collapse. Basically, the gist is, over the last 100 years, there have been plenty of reasons not to invest in the stock market. 78 of them, according to this sheet.
We tend to ignore those people and believe historically the stock market has returned about 7% after adjusting for inflation.
And the way we get there is a couple of ways, but an easy way to see it is using a little online tool called Index View. And it's just a small website, but you can pick 2 date ranges, and it will give you the averaged annualized return for that range. Now we could keep it simple and say go 1950 to 2015, and you'll see it returned about 11% per year, subtract inflation, around 7%. But Mr. Money Mustache had an article a few years ago that had a more in-depth analysis and basically took the best and worst years for an average of 1, 5, 10, 15, and 25-year spans, added them all together, averaged them, and would you guess it, it came out at about 7% as well after inflation. So that's what we use, 7%, and we'll put some links in the description if you want to research that further.
So no, we can't predict the future, and there is no guarantee, but that's not going to change our plans.
On the bright side, mixed in with all those 12% comments, were a handful of teenagers asking us how they can invest what money they already have. And we want to address that in a separate video coming up right now. So we'll see you in a second. Bye.
Bye.